This is Macro Horizons, episode 331, The Big Vote, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 7th. As the XTEL Global Fixed Income Survey gets underway, we're hoping for support and five-star votes in the categories of U.S. rate strategy, technical analysis, fixed income strategy, and short duration. We truly appreciate your help and feedback. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market got a lot of new information between the JOLTS data, ADP, non-farm payrolls, ISM services, and commentary from Powell. The market has absorbed the incoming information in a way generally that one might have anticipated. What is interesting is what this all implies for the forward path of monetary policy. There's obviously a conversation around whether or not the Fed should cut in July. We're not in the July rate cut camp, although we'll acknowledge that there are risks between now and the July 30th decision that could at least change the tone of the discussion in late July. All that being said, the Treasury market is doing nothing wrong from a technical perspective. We were overbought as the week began, in part because of month and quarter end demand, but also because of the comments from Treasury Secretary Bessent, who made it abundantly clear that he does not intend to increase Treasury coupon auction sizes this year, and probably not during the first half of next year. The logic is relatively straightforward. Given how high term premium is further out the curve, he's viewing rates as simply too high to lock in funding costs for 30 years. Instead, the market now anticipates that the Treasury Department will do the bulk of its borrowing between now and the end of the year in the bills market, which is very consistent with our expectations and to a large extent does offset the risk of a future spike in longer-dated rates based solely on the supply and demand concerns. Bessent's comments also served as a reminder of the risk of a stealth operation twist, i.e., only borrowing in the bill market, but seeing the liquidity conditions further out the curve as necessitating an increase in the Treasury's liquidity buybacks. This hasn't been announced, although the idea has been floated, and it will be very interesting to see what the summer months bring in this regard. As a theme, we remain constructive on the Treasury market over the course of the coming months, the notion being that while realized inflation will increase based on the trade war, it will primarily be focused in goods inflation, and the Fed's preferred measure of supercore inflation, i.e., core services ex OER and rent, will remain benign, certainly in comparison to the spikes that we saw in 2022 and 2023. Now, in the event that a reflationary spike is limited to goods, one should expect that Fed cuts will remain on the radar between now and the end of the year. Again, our base case remains 25 basis points in December and 25 basis points in December, although the ever-changing macro and Fed outlook is certainly a wild card for the next several months.
Even before June's payrolls report, it was an eventful week in Treasuries. We got 10-year yields as low as 4.185, Secretary Bessent downplaying the risk of increased long-end issuance, instead favoring funding the deficit with the bill market, a JOLTS print that was fairly solid all the way through, the machinations in Washington around the big beautiful bill, and of course Powell's comments, which said he's not ruling anything out at future meetings, and that had tariffs not entered the macroeconomic equation, the Fed very well could have continued cutting by now. Ostensibly dovish, but also an acknowledgement that the trade policies of the new administration have introduced enough upside risks to the path of inflation to change the trajectory of what would have otherwise come to pass in terms of the direction of monetary policy.
And progress on the big, beautiful bill comes just in time for the July 9th deadline on reciprocal tariffs. The market will once again refocus on the trade war and the forward implications for monetary policy as well as realized inflation. We continue to view the path toward a July rate cut as a difficult one to achieve, keeping in mind that we will have another CPI update as well as the first look at Q2 GDP before the Fed announces its decision. The path of least resistance is for a September rate cut that restarts the process of normalization. In the event that tariff-related uncertainty continues to run high even through September, that will shift the market's attention to the October meeting for the potential first cut. All else being equal, however, we remain comfortable in the September rate cut camp.
And in the interest of flexibility, it's little surprise that Powell said nothing is off the table. And remember, this comes after last week's semi-annual monetary policy report and the press conference before that reinforced what we continue to hear from the Fed. And that is, to your point, Ian, that the timing and size of the next rate cut is going to ultimately be predicated on how the labor market data evolves over the course of summer and into the end of the third quarter. While Powell did say that the committee would have cut had it not been for tariffs, he also said that given tariffs, the most prudent thing to do is continue to wait and see and evaluate the data as it comes in. Now, what remains a bit ambiguous is how the trajectory of series like JOLTS that showed a fairly meaningful increase in job openings and an increase in the quits rate, so higher labor market demand in May as the peak of tariff concerns abated. A higher quits rate suggests that consumer confidence also perhaps has found a bottom, and maybe the sharp global recession that was an inevitability in the wake of Liberation Day, in fact, will instead simply be an elongated period of uncertainty as trade deals are hashed out with different countries and deadlines continue to be extended and reworked as the first year of the Trump administration 2.0 continues to play out. Now, in this environment, where the consumer remains relatively healthy, wage growth is fine, if not stellar, and consumption continues at a healthy enough clip to prevent a recession, that's a backdrop that certainly doesn't point to a significant resurgence in inflation, but nor does it mean that firms are going to go on a hiring spree. Conversely, this state of limbo in terms of economic expectations also is probably not going to necessitate a massive round of layoffs, as costs needs to be cut in order to offset lost revenues. We haven't yet reached the lost revenues part of that story, and so that's a critical component of why we still see September as the most likely time frame for the Fed to deliver the next cut, and maybe some room for an in-range backup in yields, especially in the front end.
And let us not forget that real personal spending during the month of May disappointed back to the lowest levels that we've seen since 2020. All of this is a good setup for this summer to be anything other than the classic summer doldrums. Although, face it, it's been many years since the summer has been a slow time in the Treasury market. Returning to Treasury Secretary Bessent's assurances, he left the market with a clear impression that coupon auction sizes will not be increasing anytime in 2025. And in fact, we're not estimating auction size increases until the August 2026 refunding at the earliest. While this implies a period of stability for longer-dated coupon auction sizes, it also implies a material ramp-up in borrowing in the bill market. Now, investors seem to be comfortable with the assumption that the front end of the market can handle a spike in borrowing. There certainly has been an obvious downshift as the debt ceiling issue remains a factor at the moment. Once the debt ceiling is resolved and the Treasury General account is replenished, one should expect that the front end will once again come back into focus as a significant increase in bill supply hits the market. The question becomes less of pricing and more of the ability of the market to absorb the increase in supply without seeing a distortion in the plumbing of the interplay between bill supply, money market demand, and the repo rate. It's this interplay that the Fed will be watching for any signs of stress or distortion. And so this means that in the context of who is going to be the potential buyer of last resort, from the perspective of the plumbing or the functioning of the funding market, if at the end of the day the supply hitting the front end of the market overwhelms the system, it by definition becomes a systemic issue that then rises to the level of needing a monetary response from the Fed. Said differently, Bessent's decision to flood the front end of the market with bills could at the end of the day force the Fed's hand to monetize the deficit. This certainly isn't our operating assumption, but just following the process through to the end logic, it certainly is something that should be on the radar.
And for all the discussion on the risks to the dual mandate becoming more dual-sided or skewing in favor more of inflation, let's not forget the shadow, not chair, but shadow third mandate. And that is financial stability and a market, especially a treasury market, that continues to be well-functioning and serve as the backbone of the global financial system. So as we think about another reason why the Fed's easing bias is probably more durable than meets the eye, outside of simply what's going on in the labor market, the fact that the Treasury Department is likely going to be exerting at least some pressure, if not necessarily causing stress, on money markets in the very front end of the curve is not going to go unnoticed by the Fed. Yes, we have the standing repo facility and no shortage of communication from those in charge of SOMA that if anything goes wrong in money markets or otherwise, the Fed would not hesitate to act. Remember the rumblings around that conversation during the volatility of April that followed Liberation Day. And as we contemplate the distribution of the probabilities around the forward path of rates, this still advocates for a heavier weighting toward lower rather than higher. Because inflation can be cooling, the labor market can be healthy, but if something goes wrong in the treasury market, as we've seen during cycles past, the Fed will certainly not hesitate to act.
On the topic of the shadow chair conversation continues, and assuming that Trump will at some point over the summer announce his pick to be the new Fed chair, it will be very interesting to see how the market chooses to respond to what will surely be an increase in dovish rhetoric from the chair in waiting, as it were. When we look at the futures market, the market has already priced in effectively a return to neutral, or 3%, by the September meeting of 2026. This begs the question, how much more will the market price in once the proverbial shadow Fed begins to communicate an even more dovish message? At issue is how will Powell and the current committee respond to another external pressure, first from Trump and now from the shadow Fed. In an ideal world, we suspect that Powell would further delay rate cuts simply to reinforce central banking independence. The issue that triggers is that then at the June 2026 meeting, which would be the first meeting in which Powell was no longer the chair, is it reasonable to expect that the incoming Fed chair would cut rates by 100 or 150 basis points without the real economy being in some type of crisis? That does not seem like a reasonable baseline assumption, and perhaps that would be even more disruptive to the system than if Powell concedes that the incoming Fed chair will be much more dovishly minded and delivers a few preemptive rate cuts in 2026 in an effort to avoid a bigger disruption once the new chair takes the reins of the committee.
And looking ahead, post-payrolls into the first full trading week of July, while yes, there are macro impulses that will certainly be on the market's mind, a look at the data calendar, or perhaps better said, lack thereof, leaves an environment that flows, positioning, and the technicals will probably exert marginally more influence on the price action than is typically the case. We mentioned that 10-year yields dropped well below that 425 level we'd been watching, and along with that came momentum, at least on the daily charts, that stretched enough into overbought territory to trigger a reversal and bring yields back closer to the center of this new trading range in which we find ourselves. Particularly as volumes will presumably be on the lighter side ahead of the CPI report on the 15th, what we suspect this is going to translate to is a bit of a respite from the volatility and a period of temporary consolidation. Additionally, we've argued that the short base in the long end of the curve, or a steepening bias, however one wants to say it, has now come back much closer to home in this rally with presumably a lot of shorts covered and even new longs added. and will argue for a market that is now probably leaning a bit long. This also adds to the case for some period of rest before we ultimately expect 10-year yields to make a challenge back toward those sub 4% yield lows that we saw reached earlier this year.
So what you're saying is that the long and the short of it is yields will go up and yields will go down, but not necessarily in that order.
And that's insight.
Or Xtel, as some might say. In the week ahead, the Treasury market will be faced with remarkably little economic data. In fact, the most relevant known event will be Trump's July 9th deadline. At this stage, we're not anticipating a flurry of new deals to be announced. Instead, we continue to expect that there will be at least some carve-outs that make the near-term reflationary implications less dire than might otherwise have been the case, but the headlines and the uncertainty associated with the trade war will continue for months to come. On the supply side, the Treasury Department will be auctioning $58 billion 3 years on Tuesday, followed by $39 billion 10 years on Wednesday, and capped with $22 billion 30 years on Thursday. Supply remains in focus, and while all of the auctions since the Liberation Day announcements have gone reasonably well, strikingly well in some instances, there remains this lingering concern that there could be a buyer's strike in the primary market. Our expectations remain that the auctions will go well and there will be sufficient non-dealer demand to offset any concerns about a buyer's strike. We also see Wednesday afternoon's release of the FOMC minutes from the most recent meeting. Here we're not looking for anything dramatic, certainly not a divergence from the Fed's consistent messaging regarding its wait-and-see stance. After all, during the intermeeting period, there certainly was not enough clarity from the Fed's perspective to restart the process of normalization or, frankly, even to message that they're intending to cut rates in the near term. Instead, what we expect will be the biggest takeaways will be that the Fed remains on the sidelines until there's greater clarity on the trade war front, and that the economic data remains strong enough to justify an on-hold stance. Now, clearly, there's plenty of economic data on offer during the summer months that could help sway the Fed in either direction. The technical backdrop is also supportive, at least from the perspective of the seasonals. Recall that there's a strong tendency for the Treasury market to rally during the summer months, a pattern that suggests while the market will certainly be reacting to the realized economic data, there should be a developing bond bullish underpinning as well. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And in case it somehow isn't still top of mind, the Xtel Global Fixed Income Survey kicks off on Monday, July 7th. 5-star early and 5-star often. Think of it like a rideshare app, only without the tipping. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.